we decided to start with China today just because it seems that the China bulls are out in force today. Stocks are up, yuan is up. Can it continue this way?
Well, the bar, I think, is higher now. China exceeded growth expectations. Next year, I remember one of the consensus calls was for the renminbi to weaken for next year. Now not so much. And so, how do you actually deliver the marginal returns? And from here, I think that's something on the political side, on the economic side, it's essentially important. But success is measured in different ways. I think the market ultimately would take weaker than expected headline growth numbers. But if rebalancing is successful, then that's the best that China can do for its economy.
OK, how should investors actually look at the deleveraging in China?
Well, the deleveraging, I think there are two ways to look at it. One is outright debt levels. I think that is still going to maybe marginally go higher, but peak by our numbers around 280% of GDP. But I think the quality of debt growth, the quality of the loan growth, I think that's going to be much more important. Less of the off-balance sheet stuff, less of the wealth management products, more on-balance sheet lending. I think that's healthy as well, even if debt levels go up in aggregate.
Mark, is this, as much as a geopolitics story as it is an economic story for the rest of the world?
It is, but the world needs China to keep growing. And what we're looking at, 6.5% this year, slowest in 5 years or so. That's still enough to keep the global expansion going, I think. And I think Jeff's right. As long as the rebalancing happens correctly, the world can cope with a slowing Chinese economy. But you really don't want to be dipping down to 6% or so for the global economic expansion, which is the best we've seen for years, to keep its momentum going.